This is episode 1120.
What I find interesting is that the capital intensity here is unbelievably high. Like, you look at the cost to spin up and train these large language models, and it's like, there's going to be maybe 8 to 10 long-term LLMs worldwide. It's going to be a pretty small number, just given the capital intensity to gather the data and spin up the GPUs to vectorize and index everything. And so this is very, very different than what we saw in cloud. Yeah, in cloud, 10 years later, we see like the large hyperscalers, but then, we have like cloud-based SaaS applications everywhere. Yeah, they're writing on top of that infrastructure, or some of it's private and bespoke, but it's still fragmented. The nature of what constitutes a successful LLM, the training required, means this is going to collapse into like 10 gargantuan entities. And there'll be some open source and things like that. But this is kind of the concentration of capital requirements here is very, very different. Also, the broad-based applicability is extraordinary.
Hello and welcome back to CFO Thought Leader. Today we're speaking with Eric Brown, CFO and COO of Cohesity. After the past 3 decades, Eric has navigated the full spectrum of finance leadership, guiding companies through hypergrowth, leading turnarounds in moments of crises, and taking Informatica public in a $1 billion IPO. Now, at Cohesity, he's helping shape the future of data security as AI redefines how businesses operate. Join us as we explore how Eric's career has been defined by growth, crises, and the AI evolution. Our talk with CFO Eric Brown begins after this. Hello, we're speaking with Eric Brown, CFO and COO at Cohesity, a leader in AI-powered data security. Eric is a 3-decade tech financier. His prior CFO roles span Informatica, EA, McAfee, Polycom, Tanium, MicroStrategy, DataSage. I think I might be forgetting a few there. Plus, he's had board stints across many public companies. Eric, welcome.
Jack, it's great to be here with you today. Thanks for having me.
Yeah. So again, what struck me right away is that you've entered the CFO office 30 years ago. And I don't know if you look at it that way, but pretty much that's it. Do I have that right?
Yeah, I think my first CFO gig was at a tech company that I co-founded with a couple of my closest friends from MIT. Ironically, it was a data mining company, or a Gen 0.1 AI company. But when you found the company, you get to kind of, give yourself titles that you want. So I was the finance.
I'd like to ask you just about that early chapter a little bit. I know you graduate from MIT in 1990, but then I saw just in a cursory way on LinkedIn, you're in France, you're in Hong Kong, and then you're stepping into the CFO role here. I mean, is that all part of that same chapter you're mentioning to us?
Yeah, I think I've always been a finance professional. I think that my very first job actually was in investment banking before I went off to business school. And in the 5 years that you mentioned, outside the U.S., I was in a, kind of a finance director role inside a division of a larger multinational. But I was fortunate enough to be an expatriate in 2, wonderful, wonderful cities, serving as a business unit finance leader.
What was the nature of that? And I guess the question, you co-founded this company, as you mentioned. How did that early entrepreneurial experience influence your leadership going forward?
Yeah, I was really fortunate. If I look at my undergraduate days at MIT, I was very fortunate in that my fraternity brothers in my graduating class in the year ahead and behind became prolific serial tech entrepreneurs. There were multiple companies, dozens of companies founded, and a number of public companies founded by those cohorts. And so what prompted me to get up into the startup world is that, again, one of my close friends had a great idea, raw tech, I'd spent kind of 5 years doing kind of the corporate divisional finance thing. And, rather than, moving to the next job, next geography, I decided to resign and move back to Boston and, help co-found this early stage tech company called DataSage.
So even back then it was data. You were somehow involved very early on. Do I have that right?
Yeah, that's right. Back then, a terabyte was a lot of data. It's kind of funny to look back on that. We all have a terabyte of storage on our phones today. But yeah, it was all about data. It's just, kind of a smaller amount of data, back then. But the concept of, working with data to provide value has been a recurring theme over the years.
Where does the finance lane come into focus for you? I mentioned you have this string of CFO appointments over time. But, are you an entrepreneur? When did you start thinking of yourself as a CFO, really?
Yeah, I've always been, I've always had a growth mindset. I've always had kind of an owner-operator mindset. I've always been a builder. I've operated at, single-digit million revenue scale and 4 to 5 billion revenue scale and pretty much everything in between. But I've always had this mindset of, looking for growth and looking for innovation. And, when you're in a good market with a good product and a motivated team, you can really, do some wonderful things and create some real value. And so it's kind of the thrill, the pursuit of growth and a net new opportunity that's always energized me over the years.
Can you tell us something, when a new opportunity came your way, what allowed you to say yes?
Yeah. I mean, reflecting back on, kind of the DataSage situation, I was watching from a distance a lot of people I knew really well, startup, companies, and they're just so excited, talking about the experience. And, I'd kind of done a 5-year tour of duty and, at that stage, I had the opportunity to make a complete change, resign and say, hey, let's give this a go. Like other people are doing it and there isn't any reason I should do it. It seems like a super solid tech idea. And, we have a passionate team. We felt that, we could just go build something. And the beauty at that stage, I think, when you do your first company like that, it's, you don't have 100% knowledge of like what can go wrong. And that's kind of the beauty of it. You're just kind of convinced, it's going to work out despite the, the odds that are against you in startup mode. And, that was fortunate in that, kind of worked out. And I've had that tech growth mindset since then.
When you move beyond DataSage, you go to MicroStrategy. Can you just tell us, that seems like as a CFO, it looks like it sort of validated your future right then and there. Tell us something about that decision.
Yeah, I think that the decision was, initially I did not join MicroStrategy direct. I joined a 100% owned subsidiary called Strategy.com. And my job at the time was to take several $100 million of proceeds from a planned upcoming secondary by the parent company MicroStrategy and build, we call it a personal intelligence network, which is founded on the concept that, WAP protocol phones could provide personalized information. So, this is back circa 2000, right before smartphones. And, so that was the plan, and we were looking to independently, spin that up. And, about a month into that, the parent company had a restatement in the middle of the secondary, didn't raise the planned $2 billion, raised zero. And it, turned into a real, kind of challenging situation. And, I was elevated from the divisional role to become the corporate CFO to, clean things up. And it was, probably the hardest thing I had to do professionally because, the company was spending money like it had just raised $2 billion, but, it had a minus 40% non-GAAP operating margin and was, burning a massive amount of money every quarter. And going from thinking, I had unlimited money to like zero money in a short span of time required a pretty massive restructuring, effort. So I kind of jumped into that and, as part of the team that, kind of righted the mothership,
Wow.
And, kind of grew from there.
Again, it was nearly a 5-year investment over time with MicroStrategy and that smaller venture you were part of originally. We'd like to focus on the investment of time and years. It was also the first time I would think, because you weren't a co-founder, you had a CEO as a partner. And that's something that you clearly have done successfully going forward. Any advice how to partner with CEOs? You've had a string of them. And again, why didn't you never thought of becoming a CEO yourself? You knew finance was your lane. Help us understand better. What's your mindset in that C-suite?
I think the partnership, particularly in a public company, between the CEO and the CFO is unbelievably important because, invariably you're going to face some challenging situations and, the CEO and the CFO are going to have to lock arms and lead the company, the investors, the board, outside constituents, or all the above simultaneously, in a certain direction through potentially some challenging times. That was certainly the case at MicroStrategy. Make no doubt about it. You're looking at one of the few survivors of the 99.9+% peak market cap to trough market cap decline. I'm a survivor with a, 1-for-10 reverse stock split thrown in there for good measure. So, having alignment with your CEO when you're going through a challenging time is exceedingly important. And it's a very, very rare company that'll go through a 5-year period of time with, no disruptions, no hiccups, no, kind of special situations. And so that's a really important relationship. It has to be centered on, trust, mutual respect, complementary strengths, similar work ethic, shared goals, etc.
More recently, you led Informatica's IPO. You raised $1 billion back in, is it 21? I don't have it in front of me here. Mm-hmm. Was that your first IPO? I somehow doubt it. But what would you tell us from your IPO sort of history?
Yeah, that actually was my first IPO. And it's interesting because, Informatica wasn't directly in the data space, like the analytics layer. Like MicroStrategy, for example, is clearly in the analytics layer. Cohesity is in the data security layer. Informatica is kind of the ETL data management layer, which is it's adjacent, but it's different. But in any event, I knew the space quite well, which is helpful. And then secondly, the company was private at the time. So it was previously public, was taken private in 2015 by 2 PE firms. And, I knew the business really well. It was clear to me that more likely outcome for that business was to go public, at least initially, versus going private. And, the board and the PE firms felt that, this is also a candidate to go public. And, I've been very successful as a, public company CFO in other scenarios. And so there's a really good mutual fit. And from my perspective, thinking selfishly, I really wanted to do an IPO. I was at one other hypergrowth private company. I was convinced, we were going to go public. It could have gone public, but, controlling shareholder decided, not to go public. It's okay, that one didn't work out. Informatica was attempt number 2, and it definitely, worked out. We took it public in October of 2021.
Your involvement with all these companies, what other milestones? Were there obvious transactions, acquisitions that you were involved in? But when you look back over this storied career, what else? The Informatica IPO, the correction there at MicroStrategy. What else?
Yeah, I think like I said, I think the toughest thing to do was the MicroStrategy turnaround, because that was it was almost existential, literally staying solvent. Yes. And like I said, the peak, the trough, market cap delta was unbelievable. But it was a great business core, great core product. We powered back, from that trough. That was a lot of hard work as a lesson in, perseverance and really understanding, inside a tech company, when you're forced to take out 2/3 of your cost in your workforce, you have to think really, really hard about, okay, what's generating value inside the company? What you quickly realize is that it's your core engineering team and your high performance sales team. At the end of the day, everything else is just a support function. That's kind of a really important lesson that served me very well in every other company since then. So that was not just a milestone, but a pretty significant learning experience. And, having been through that, nothing really phases me, to be honest. Other great milestones. We executed a digital transformation, electronic arts. Going from packaged goods, retail disc sales to pure digital delivery of games. And so that was a multi-year journey. And we all now take for granted that, most games are delivered or downloaded digitally. Wasn't the case back in the 2000s. There's other lessons too. The short, tour of duty, 2 years of Polycom, pure hardware business. My takeaway from there is that I don't like hardware. Software is much better. So it's been my one hardware company. So I think I kind of learned that. I had, an awful lot of fun working at Tanium. It was the, quintessential hyperbolic Silicon Valley startup where, the ARR, the year-over-year growth rates were just, the first 3 years spectacular from 8 million to over 70 million to 150 to 220 and change. And so hyperbolic growth rates, hyperbolic increase in, valuation. And, the takeaway was, talent acquisition early on in a hypergrowth cycle is, incredibly important. As you're, adding literally, hundreds of people every month or every quarter. So some really good lessons, from that. I'm really proud of that because, it's a hypergrowth startup. We raised tons of money at high valuations, but we were operating cash flow positive in the first 3 years, which is extraordinary to have those kind of growth rates, raise all that money and not need to spend any of it because you're OCF positive. So that, I'm particularly proud of that. I haven't seen a company quite replicate that since then, at least those first 3 years.
I'm curious, these opportunities, is it your network? Are you working with recruiters? You must be awfully well networked, is my sense.
Yeah, I think at this point, I'm, pretty well networked. I mean, I've been physically in Silicon Valley since, 2008. That certainly helps. I've worked at a lot of, high profile public companies. So my network of, sell side analysts, buy side investors, investment bankers, lawyers, accounting firms is pretty extensive. And, as a result, I'm pretty well networked.
Your career, I hate to do this to you, your career begins in the end of the desktop era, really, or the beginning of the internet, I would say. Yeah. Over the 25 years or 30 years, all these technology waves, I'd love to hear some perspective on this latest AI developments here, is what's happening now versus, we all experienced the cloud and we saw how that became a phenomenon, but this is different.
Yeah, this is a little bit different. I mean, we, compare this, kind of to the .com era, the web, let's call that, 2000 plus or minus. This and cloud, cloud's been, everyone's been talking about cloud now for there's no doubt that, cloud is another huge revolution, but it's been growing at, high, but kind of moderated, rates. It's been a multi-year journey. Because I reflect back upon the early days of the cloud, everyone's thinking, oh my gosh, every single workload is going to move from the cloud overnight. Okay. So here we sit, 10 years later, and that is not the case. We've seen the rise of the hyperscalers who are demonstrating great growth rates at massive scale, but there's still, on-premise applications, everywhere. And now we're seeing there's very subtle different variations or vintages of cloud. There's classic public cloud, then there's private cloud, then there's self-managed, and then there's, sovereign cloud, and there's the extreme version of sovereign cloud with sovereign citizens operating the sovereign cloud. And so, it's not kind of the winner take all monolith that was anticipated 10 years ago. AI is, I think we're on the cusp of something fundamentally different. What I find interesting is that the capital intensity here is unbelievably high. You look at the cost to spin up and train these large language models, and it's there's going to be maybe 8 to 10 long-term LLMs worldwide. it's going to be a pretty small number, just given the capital intensity to gather the data and spin up the GPUs to vectorize and index everything. And so this is very, very different than what we saw in cloud. Yeah, in cloud, 10 years later, we see like the large hyperscalers, but then, we have like cloud-based SaaS applications everywhere. Yeah, they're writing on top of that infrastructure, or some of it's private and bespoke, but it's still fragmented. The nature of what constitutes a successful LLM, the training required, means this is going to collapse into like 10 gargantuan entities. And there'll be some open source and things like that. But this is kind of the concentration of capital requirements here is very, very different. Also, the broad-based applicability is extraordinary, right? My very, very first startup at DataSage, we had a neural network. It was an AI company. And, we struggled mightily to build a couple of vertical applications over a couple of years. You can now spin up agentic AI applications in weeks. And, I had this interesting conversation with my head of, applications not that long ago. And we're always looking for a way to like take cost out of our internal IT spend run rate. And we were looking at one vendor that we use. I'm not going to name them, but they're a mega capped cloud tech company. And he said, what, with agentic AI, with half a dozen people in a month, we could completely replicate that application, which for me would be like, wow, I can take, $1 million a year spend out of my run rate. I'll spend maybe $200,000 to build it, and maybe at most $75K a year in maintenance mode thereafter to avoid, $1 million of recurring cost. I mean, that's like an order of magnitude reduction here.
Wow.
And so that's just like one small example. And the other thing that we're seeing is very different than, kind of the cloud or the web, revolution, is like the strategic importance of data. And so data has become a critical, asset. And so, the company that controls the privileged data is the one that will be able to enable agentic AI more rapidly to drive their top line, optimize their bottom line, and ultimately produce disproportionate returns versus the competition. And so, there's a data battle here that is going to be epic and enduring. And again, I didn't really see that, in the cloud. Not all the data moves overnight. It never will, and it wasn't as applicable in kind of the 2000s, kind of the web revolution. So, kind of the conditions are different. The capital requirements are massively high. It leads to concentration, and the broad-based applicability of the tech is just absolutely mind-boggling. And we're barely, I think, seeing what can be done here. I think what we're going to see over the next couple of years is like every single company says, yeah, they have to report to the board. Yeah, we have an AI story. It's like a check the box thing. And, have they fully deployed agentic AI? No, they haven't. I mean, companies are still struggling to aggregate their data, their permission data, which is necessary to build agentic AI, right? So, people are going to spend much more time focusing on that than they ever have before, because the value of that data is like 100 times what it used to be. And that, ironically, is the space that we're in today at Cohesity. Like, we are a data protection vendor. We back up all the data. So by definition, we have in our file system all the valuable data in one place already curated, right? And so we're now working to AI enable that data on behalf of our end users, and we're seeing a lot of interest there. And it's, it's strategic interest as opposed to like IT infrastructure type procurement cycles and interest. So, again, we're kind of like a second order beneficiary, as it were, of the AI revolution. The LLMs, the capital intensity, that represents the absolute leading edge here.
Well, thank you for that perspective. You revealed to us pretty much what Cohesity is up to, in a sense. And maybe you can tell us a little bit about the acquisition last year of Veritas. I mean, after that was announced, it became, you folks said you were now the largest data protection software provider by market share. I'm wondering how that has transformed your business strategy in some way, or positioning, your competitive positioning? What has that done?
Yeah, I think, first of all, this trend is a landmark transaction. This would make an amazing business school case study. So just to kind of like the setup here would be as follows, Cohesity, private company with a GAAP run rate of about $550 million in revenue, just hitting break even. It's kind of like a classic Silicon Valley late stage growth oriented company, at break even 550. We buy a company, actually not a whole company. We bought 72% of Veritas. So we did a carve out from a private entity, which increases the degree of difficulty dramatically, by the way. But the entity that we bought was effectively, double our size, 1.15 billion in GAAP revenue. So you ask yourself, well, how does a company of 500 million buy a 1.2 billion dollar company? Well, the answer is, you have to have a compelling case for the combination, and you have to raise a lot of capital to effect the sale. The compelling case is pretty simple. Horizontal consolidation, Veritas, incredible install base, but old gen product, Cohesity, next gen hyperconverged product, better together, 4,000 customers plus 9,000 you put together, super high grade enterprise grade customer base with only 2% overlap, which is unbelievably low. And to finance it, we became a deal specific private equity company. We raised $950 million of equity and $2.8 billion of debt. It's just kind of like what you'd see in a normal kind of PE transaction. So we did this all on our own. We sold Cohesity equity, on the basis of, closing this transaction and, put the company together. So we closed the deal about 8-9 months ago. So it was December 9th last year. And what we learned since then, it's not an acquisition. It's not a merger of equals. It's a merger of unequals. 1/3 revenue Cohesity, 2/3 coming from Heritage Veritas. It's been like I said, a very complex financing transaction. There's a lot more details beyond just the high level stats that I shared. Merging the sales teams, the marketing teams, the back office teams, and the core systems to operate efficiently has been a lot of work. We've integrated in, record time. As I sit here today, we've converged every single system except the customer care system, which will be done this November. And so, we integrated systems at probably, 3 to 4 times the rate at what you would typically see in these large, M&A transactions. Customer response has been great. The core thesis of the deals that the company would be better together, and we'd have a better combined roadmap and a future migration path and future-proof the Veritas install base has proven out to be absolutely true. So at the core of it, like it was a good idea. It wasn't just, financial engineering. The core idea, looking at like what the product value proposition is to the combined customer base, has been rock solid. And I think that's been, it's been great to see that play out.
So there's always sort of the key financial or operational risks would be the integration of this, the support costs associated with it, and the partner management, some of which it sounds like you have all nailed down. But what are the analysts, when they do ask you about this, what is it that they're concerned about?
Well, I think that, the basic proposition of the deal was, well, can you deliver, within a year or so of closing the deal, and integrate a product roadmap and realize the synergies that you talked about as a basis for underwriting the deal? And the answer is to both those key questions is yes. We'll be rolling out end of next month. So it'll be 10 months close of the deal. An integrated product release, which is great for, both install bases. And, we've impounded as of today, 90+% of the overall cost synergies for the last 10% schedule, over the next 12 months. So we're tracking to that exactly as well. So from a financial model point of view and from a products, roadmap integration point of view, we've done exactly what we said we would do.
From a customer experience, what are your success measures? What are you looking at to make certain that, the customer experience is being sustained and improving?
Yeah, that's super important. So customer satisfaction, net promoter score before, after the deal. And then ultimately, your gross retention rates, right? Because people renewing your subscription products year after year, that's kind of the ultimate vote of, of confidence. When we also have customer advisory boards, and what we hear from, those like significant lighthouse customers is also really important. And again, it's all these different points of feedback that tell us, we're on the, on the right track here. In addition to that, there's usual indicators and metrics like, number, caseloads, product quality, number, P0, P1 incidents, that type of thing that the customer care team, would track. We spend a lot of time as an executive leadership team. In fact, every week we review not just customer sat, but, kind of the escalated, customer caseloads. So we know exactly what's going on. So we as an extended team can make necessary decisions to solve these things on behalf of our customers. So we take that very seriously. It's front and center on a weekly basis.
Yes. Can you share with us, just your approach to organizing finance? And when you say those customer caseloads, are your finance team members involved in those caseloads, or helping, supply information to better manage them, or what? Help us understand better.
It's more of the latter. They're supplying, the information to make sure we're getting the right data, the right KPIs. But, kind of customer care resolution, it's ultimately the responsibility of the customer care team. And it is necessary, engineering, depending upon, what level, the escalation is. I, as a exec sponsor of a number of accounts, like if one of my accounts, and actually I have one of them today that has kind of an elevated customer caseload, and there's an exec sponsor, like I stay involved, but that responsibility is not distributed to people below me in the finance org. I have them focused on, IT system integration, delivery, producing the gap numbers, optimizing the business, et cetera, as opposed to dealing with a technical product issue.
Yeah. During your career, again, all these, different appointments, you have watched, customer success organizations evolve and have seen how finance has complemented them or interacted with them over time. You've seen organizations reorg to get it right, to understand better who needs to be positioned. Can you share with us, as you stepped into this role, do you have a certain mindset about how the role finance plays as it relates to customer success and, that corridor?
Yeah, I would say that it's probably more important that the finance team, and it depends how you define finance. It could be, finance with ops, with the deal management team, rev rec team, but if you look at kind of a broader definition of finance, you're most focused on, okay, what's the pipeline look like? And what does it take to get a deal across the finish line from a deal structuring point of view? And, how can we, as necessary, work with the field to structure a deal to get to the desired outcome? Their finances, it's much more heavily engaged than when after the fact, when it becomes like a product technical issue, right? You're just not going to ask a finance person to go solve technical product issues. It's just not a good use of time. So in terms of customer sat, it's more kind of at the front end where, I have my team, pointed and oriented.
Yeah. Just in regards to your FP&A team, do you have any rules of thumb, how you manage, where you find these people, what you might do differently than other CFOs when it comes to managing your FP&A folks?
Look, I'm a very detail oriented, individual. And so depending upon what's required, GAAP, actual accounting issues or FP&A, I'm pretty engaged. And in the case of Cohesity, just given the complexity of the transaction, merger of unequals, putting everything together, making sure that, we had to, realize that, the cost synergies and the financial targets that we set out. I've been, very highly engaged on the FP&A front in my, the last 2 years. And so what I look for in my FP&A leader and, the team beneath them is, I distilled this down to one word, which is called ownership. And that's what I look for. And so ownership is okay, that's a broad term, but there's a lot wrapped up in ownership. Like if you've worked in a startup company as a finance professional at an early stage, you understand what ownership is, because you start with a job description and a title, and it's like, okay, yeah, but you have to go solve like 5 other things that day in addition to what your job title would suggest. So ownership of outcomes is really important. And for when you have real ownership of outcomes, you get to the kernel of the problem, you understand the details, the risks,
Right.
the opportunities. And when you're presented with a problem, you reverse solve it and you don't let go until it's solved. So one word, ownership, is what I look for, not just in, FP&A professionals, but like other folks in the extended finance team, right?
Understood.
If I could screen for one word, I screen for ownership.
I was intending to touch on AI more quickly with you, but sooner, that is. Tell us something about your AI investments and maybe your mindset when it comes to investing in AI and trying to understand the ROI attached to those investments.
Yeah, I think that every company right now is figuring out, like, okay, what does AI mean for me? Can it drive revenue? Can it optimize costs? Can it replicate, high cost headcount? Can it supplant existing systems? The answer to that is yes to all the above. Every company is going to have to figure that out. So our AI investments consist of really kind of two categories. One's like, we have built and we're selling today an AI product. So there's a whole initiative funding R&D, et cetera, product management, and go-to-market, et cetera, around the Cohesity AI product, which is called Gaia. And in terms of internal use cases of AI, we are, we have kind of a loose coalition of different executives and contributors and different functions who are sharing the agentic AI apps that they're envisioning to, better their department's functions. And these things are like spinning up. And so we have, we've elected to have a private cloud AI model. So we, house on premise or in our own private cloud an LLM, and all the data that we're using is our data. It's not going to just, pure, public, company infrastructure. So we've elected to use like kind of a private cloud approach. Back to my earlier comments about cloud and how it evolved into sovereign clouds, private, public, et cetera. We've elected to be more guarded in terms of the AI rather than generically submitting it to an LLM to get back a query. It's like an LLM, an environment that we uniquely control. And I think a lot of corporations are going to go that route, right? Because, again, data is a strategic asset. And so what we're doing is like customer care call deflection. We've loaded up a couple years of case resolution from the customer care team. And so first response, suggested diagnosis, we're seeing extraordinary, payback on just that one application. We're digitally or AI enabling, like we've taken every single policy that we have, and someone wants to onboard and, rather than reading like a bunch of policies, you want to just freeform query our policies, T&E, whatever. It's like right there. You can get an instantaneous, summary. We're looking at, when we evaluate outside, vendors and application purchases, I'm personally investing time with the founder of an AI enabled go-to-market application to really understand the tech. Because if we're going to make an investment, we're going to go deep and decommission, as I noted earlier, a lot of other kind of like legacy traditional, SaaS applications. And so, there's an opportunity. There's going to be all kinds of like specialist AI enabled vertical applications that become available. So the question is like, which one of those makes sense for your business? Because the difference between an AI enabled, SaaS application and traditional SaaS application can be dramatic in terms of the benefit, the payback, et cetera. And so it's going to be a super exciting time in the short term for, agentic AI applications, to spring up. These companies, they can spring up and scale very, very quickly. They can go from 0 to 100 million in ARR in 2 years. That's kind of like unheard of in a traditional application environment. So identifying those AI applications that make sense for our business and just having the courage to swap out what we used for like 5+ years for something that new is something that we're doing and encouraging. And of course, then there's the coding productivity gains. I don't have an exact stat on that, but, we're using agentic AI to become more efficient in terms of, lower level coding tasks. So that's going to be, long term, I think, tremendously beneficial for our R&D, efficiency.
Yeah, some wonderful perspective and some interesting insights there for us. Thank you for those. We are up to what we like to refer to as our finance strategic moment. Again, very often a finance leader might look back in time and share out a restructuring, perhaps. I don't know, but can you go back in time and maybe identify a finance moment for us where, as a leader, you had a strategic insight given your lines of sight as a finance professional?
Yeah, I think that, I kind of reflect back to kind of the MicroStrategy kind of situation. I touched upon that earlier, Jack. And it was literally, I'm not sure if it was strictly speaking, financial insight, because that you have a flash of insight suggests you went from a good situation to even better situation. This is a situation. It was existential, literally. Like, we're about to delisted. We're about to run out of money. We had class action lawsuits outstanding, and like everything was working against us, and we just had to bear down. And we had to restructure. 2,500 person. We had to take it down to 800 people. So basically two thirds layoff, which wasn't pleasant, but it was like existential. We had, like I said, minus 40%, op margins, no cash buffer, and a temporary inability to access the capital markets for more cash. And, proud to say that, we went from about minus 40 to plus 30 over the course of about 2.5 to 3 years. So a 70 percentage point swing, right? In terms of op margin, minus 40 to roughly plus 30. And, market cap, it bottomed out, believe it or not, at 55 million. So 0.35 times revenue. I don't really think you think of like revenue multiples like 8x, 10x. Yeah, we were 0.35x, which, in software land, the market, there's a poly market back then. It says, you're eventually going to be roadkill as a company. That's what 0.35x means. So we powered back from that to $55 million market cap to like, well over $1 billion, 30%, operating margin, through that process. And so, the learning there, it wasn't, kind of a strategic moment. It was, the realization that to continue to exist as a company, we had to change and improve everything extremely quickly. So that was kind of the learning there. That what seems to be impossible things actually can indeed be done.
Wow. Anyway, it happened twice. You're still discussing it. It must be such a incredible chapter. Thank you for sharing it with us. We're going to go to what we refer to as the mentoring round. This is where we often ask you about that first 100 days in the role. You've done it so many times. It must be familiar to you as you enter a new CFO office. What advice would you have for new CFOs? What is it that you do in that first 100 days that you've learned over time? I'm not going to do that.
Yeah, I think, look, understand first of all, understand why you're joining a company. If you don't understand the core tech, and what the core invention is, not just like the products and, not just running off, but like why, what drives the company and what causes customers to buy the company's products versus alternatives, B, C, and D. You need to know that in advance, because knowing that in advance is going to, give you, a much better means to figure out like where you can add value. What are the true operating levers of the business? Sales productivity, is it high? Is it low? Are you, at the top of like a new product cycle, or do you have, a period where you've got old tech and you've either got to reinvest or, partner / OEM or possibly acquire? Like you need to know these things, I think, you need to have this at least high level diagnosis prior to joining the company. If you haven't done your homework, and you're going to have, your first 100 days are going to be, rather than having an impact, you're just going to be taking up a lot of people's time, asking a bunch of questions. And so we want to be able to like, yes, there's going to be ramp time in the 100 days, but it's probably better that the ramp time is spent getting to know your executive staff colleagues, right? And building one-to-one trusted relationships with each other. I always tell my team is that in this digital age, like you want to have, personal relationships established. Ideally, you're talking face to face, or, staff is everyone on speed dial on their cell phones. So like the 100 days is about building those bonds with the executive team, because what you have to do as a CFO is most of the time you have to solve kind of cross-functional issues or decisions, right? Because at the end of the day, you're kind of like the resource allocator for the company. and you've got to maintain kind of an informed, neutral point of view and be able to kind of arbitrate, multiple viewpoints. And that's going to start with trusted relationships. And similarly, in 100 days, you need to know your team, and you should have figured out within 100 days, who the keepers are. And if you're going to have to make a change or an upgrade, or, you spend a lot of time getting someone up to the level they need to be, you should have that sorted out within the first 100 days this way.
Nice. We always like to ask our guests to reflect a little on the personal side. You joined Cohesity in 2023, I believe. So your colleagues might not know something about you. Anything from a personal side, outside the professional world, a pursuit that you have, an interest, something?
Yeah, I think, so even though I've, lived in Silicon Valley with the family since 2008, I grew up in a small town in Michigan, town called Midland, Michigan. And, it's still kind of like, emotionally home. And one of the things I do in my limited, free time is that, in my place up there, I actually grow grapes. It's all outsourced, as you can imagine, because I'm pretty busy with my day job. But I consider myself like a gentleman farmer, as it were. So I grow grapes, and my fascination with it is that it's great because you get to produce wine. I don't make wine; I just sell the fruit, to be clear. But like it's a sharp contrast to what I do day to day. Software is like the ultimate intangible, right? You send someone bits and bytes, and they send you a check for $1 million a year. It's like the ultimate intangible. Whereas, doing something like growing grapes, it's very tangible, right? You see them season to season, grow from nothing to harvest. And that's, for me, that's kind of a fun thing I do, on the side with my limited time.
Wonderful. Thank you. Thank you for that. What about, is there a book or a resource you've relied on over time, or something that influenced your thinking along the way? Doesn't have to be a business book.
Well, actually, in terms of, probably one of the, just like kind of the single best, if you're a finance professional, you read and kind of like literally memorize like one book, and this is going to be finance specific. Now, there's a lot of good general business books out there. Yeah. But like, again, I'm a big believer in like understanding the fundamentals and like how to do cash flow assessments and, read financial statements and find leverage points, et cetera. It'd be like, I point to Briley and Myers, corporate finance. It's like the quintessential textbook. They're probably on edition like 16 by now. It's been reprinted and extended and augmented many, many times. But it literally is, from my perspective, it's like the corporate finance Bible.
Yeah.
And, I read pretty much all that. I didn't memorize it, but I read all that, at business school. And, today, again, time to time, like those fundamentals like come back. Particularly the Cohesity situation, having going from unlevered to a levered capital structure and thinking about debt equity and coverage ratios and things like that is all unbelievably directly applicable.
Yeah. Oh, wonderful. Thank you for that. We're up to our final question, and this is where we ask you to look forward finally. We're interested in what your priorities are for the coming 12 months. What would those be?
Yeah, I think that, we fully intend to take Cohesity public. And there's a couple of aspects to, taking a private company, public. There's an awful lot of work that one has to do in the back office. You have to have super tight, unified, GAAP reporting systems. You have to have, back office that works cleanly. It's not just finance, legal, corporate legal is like a super important part of that as well. You also have to have predictability, and that's where the partnership with sales and sales finance is super important, right? Being able to put together, an IPO ready, beat and raise model and having good visibility, great visibility out, certainly 90 days at a time. So building that predictability and visibility is a big part of the journey. And then ultimately having the right, kind of like profile. And the market right now, everyone talks a lot about, this, rule of 40, right? Which is, year-over-year growth rate, that percent plus percent of profit margin or UFCF margin, choose your profit metric. And, ensuring that Cohesity has that right rule 40, profile. And in our case, we're thinking it's easier for us to hit the profitability. We have to spend more time about thinking about how do we drive, that first number, the year-over-year growth. So in the journey to IPO, I kind of break it down into those kind of three categories, kind of the basics, the fundamentals, the predictability and then kind of the company profile and, making it as attractive as possible for the public company investor.
Eric Brown, thank you for joining us on CFO Thought Leader.
Thanks so much, Jack. I really enjoyed the time today.